Welcome back to the Legacy Radio Network. You're listening to the Everything Financial Radio Show. We are here every week at this time. Glad you're with us. I'm your host, Dennis Tubbergen. We are going to continue our conversation with Mr. Karl Denninger. And, Karl, in the last segment, we were chatting about really exclusively Europe. Get out your crystal ball and tell us, in your mind, how this likely plays out. What is the end game? And to the extent you're comfortable, what's the time frame of the end game?
You know, there's an old saying, you never ask somebody for the direction of a move and the timing, because one of the two is going to be wrong.
Pick the one you like.
Yeah, I don't like the prospects forward in any sense. We've seen, you know, of course, as everybody knows, a huge move in the stock market and asset prices, financial assets, over the last 2.5, 3 years. And that move was predicated upon the idea that the leverage in the system and the accumulation of debt could continue roughly as it had from the 2000 timeframe forward. This is a lie. And so what you're looking at here is a market that is overvalued by 50%, maybe even more. And of course, when things correct, they tend to overshoot. As we've seen, there's been no recovery of any substance in housing. In fact, it's exactly the opposite. We're getting declines again. Housing is still overpriced. So ultimately, I see a reset, if you will, to sustainable values coming in all asset markets, but it is not going to be a straight line because the policymakers will, of course, attempt to intervene in any way that they can. My expectation is that we're not going to get through the elections. Everybody says that, you know, the big fiscal cliff things and all this other stuff in the United States, at least, will not hit us until after November. And that was the intent when they did the last deal back in August of last year. It's not going to work that way. It didn't work that way in 2008. It won't work that way now. I would say, you know, the fetal position under the desk is a fairly decent place to be for the next 3 to 6 months because I anticipate great turmoil going into the end of the year.
Karl, that certainly is an interesting word picture. And you know, we're talking about Europe. We're talking about the banking system. And sometimes we focus so much on Europe that we miss some other stories that may be even bigger ultimately in the long term. I read this past week that China's economy has slowed for the 7th consecutive month. China has long been thought to be in for a soft landing, but it certainly doesn't appear that that's the way it's headed. Give us your take.
No, China's going to crash. There's no soft landing coming here. You look at the reports that are coming in from around the world. Australia was supposed to be building a new coal terminal because China's demand for thermal coal to generate electricity was off the charts. Now all of a sudden that's been canceled. Wait a minute, how come? Why would you cancel the construction of an export terminal that's exporting a great resource if there's demand for those exports? Well, obviously the demand has evaporated. The big problem with Chinese numbers is you can't trust any of them because there's no independent verification. And really, when you get down to it, the balance of payments problem that China has brought upon itself is an unsustainable mess, and this is going to unwind and blow up in the Chinese government's face. We've been looking for, okay, when exactly does this happen? The timing is not the issue here. The inevitability of trying to finance what has been going on over there within the Chinese economy is where the problem lies. And remember that it's not just the United States that is their export market, it's also Europe. And Europe is in a tremendous amount of trouble. So I think the Chinese situation is going to get much more serious. We're going to see the shock initiated from Europe, but the second round of this is going to come both from China and, believe it or not, from Japan, which has not managed to get out of the mess that that was caused by the tsunami. And they've still got a huge issue over there with regards to electricity production because all of their nuclear power plants remain offline at this point.
Karl, let's turn our attention here to the United States. The Federal Reserve will be meeting again in June. There's been a lot of speculation that the Fed will engage in a third round of quantitative easing. Dr. Mark Faber was on our show not long ago, and he said that the Fed will engage in QE 26. Jim Rogers had said that Bernanke will quit printing money when there are no trees left. What is your take?
I don't buy it, and it's just simply because it hasn't worked. The only thing that QE has done is increase the price of financial assets. Okay, now that sounds like a win if that's one of your goals. Of course, is to so-called provide the something for the 1%. But it's come at the expense of asset stripping the common man. The common American has seen about 25% of his purchasing power destroyed over the last 3 years by all of this quantitative easing and zero interest rate policy, and that money has gone to prop up the banking system. The problem with doing this is that when people starve, they riot. And so in order to prevent that from happening, the government has been taking that printed money and handing it out in the form of benefits of various kinds, from unemployment to Medicare, Medicaid, everything else. But now the government is running out of the ability to do this because of the fiscal problems and the fiscal cliff that's being brought upon us. Bernanke is not about to let the United States go through a situation like is happening over in Spain. And so I see him at some point, and I don't know whether it'll be this next meeting. My guess is no, but somewhere down the road, he's going to throw up his hands. He's going to say, look, you guys cannot continue to deficit spend like this. I'm not going to finance it anymore. And that's essentially what he's been doing with all the QE. And at that point, the pendulum shifts back the other way, and we get the correction. Of course, people inside the banking system will know when this is going to happen. So you can bet that they'll try to make money on the way down, just like they did on the way up.
Carl, you talk about the fact that at some point Bernanke will say, look, you can't deficit spend like this. And I'm reminded of the economist Herbert Stein, who said, if something cannot go on forever, it will stop. It's a very profound statement. When you look at the deficit spending and look at just interest on the debt and entitlements, it really consumes all tax receipts. So you don't quit deficit spending without attacking entitlements. Do you see any politician out there with the fortitude to be able to address this problem as it exists honestly and openly and actually come to a solution?
No, but they have to. And see, that's the conundrum, is that you look at the numbers that were just out this morning. We have the federal government's spending just on medical benefits alone has expanded at a 9.3% compounded annual rate from 1980 to last year. I just saw a statistic this morning that says it's going to be up more than 7%. Well, a 9% compounded growth rate, spending doubles every 8 years. All right. Well, last year that was about $820 billion, which means in about 15 years it will be the size of the entire federal budget today. That obviously is not going to happen. So if we don't take this on, and it's not Social Security. Everybody tries to conflate Social Security with this because that's the grandma down the stairs thing, and that's what all the politicians like to do. But it is not there. The problem is in the medical spending, and we have got to fix not Medicare and Medicaid, but the medical system, and that means throwing the entire health industry in this country under the bus. And it has to happen, and it has to happen now. We can either do it today and end up with a situation where people who have self-inflicted injuries or just have chosen not to take care of themselves have a really rough time, and we go back to this sort of charity care provision that we had in the 1950s and 1960s before all of this craziness went rampant. Or the alternative is we're going to bankrupt the country, we're going to bankrupt the government, and we're going to bankrupt the American people, and it's all going to be in that one area. We are now spending twice as much as any other G8 country on medical care, and we're getting worse results. And the bottom line is we're cost-shifting everything and subsidizing the provision of that care to everybody else in the world. We're 330 million people. We can't do this for billions of worldwide residents. It just isn't possible.
Carl, do you see the policymakers addressing this before the bond market forces the policymakers to address this? When we start seeing interest rate spikes on U.S. government debt, is that when this all hits the fan, or does it happen before then?
If the policymakers don't address this, we won't get any warning. And the reason is that when you have $15 trillion, when you have essentially 100% GDP, we go from the current situation where we're spending a couple $100 billion in interest, including our embedded shifts within Social Security and Medicare, so-called trust funds. And let's say that today the 10-year Treasury is trading right at 1.6. Let's say that it doubles, goes to 3%. You more than double the blended rate across the board. You more than double that interest expense. This then means you have to take another $300 billion out of the budget, more than you did before. So the spiral effect on this can sneak up on you very rapidly. I think the fiscal realities of this are going to come to the fore probably before the bond market totally throws up. We're benefiting right now in the United States from the fact that Europe is about to collapse and splinter back into national currencies. That will not continue, and when we get that situation and all that money floods into United States treasuries, the worst reaction that the politicians could have is that, oh, well, we can do this in the medium term. You keep hearing that in the political discussion. No, 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 because if you have this kind of deficit spending going on when the spike begins, it will be essentially impossible to put a stop to it. It needs to stop now while we have the ability to roll duration out into the 20 and 30 year time frame and take advantage of it today, but that's a temporary phenomenon. The budget cannot be cut slowly. We have to take the deficit to zero, and it has to be done today.
Karl, we've got about a minute left. Give me your take on how the presidential election here in the U.S. is likely to play out.
Well, I expect that we're going to get a major dislocation, probably initiating in Europe before November. I don't see how they're going to manage to stave that off. That never plays to the benefit of the incumbent. So with the polls being as close as they are right now, this says that we are likely to have President Romney come November. The big problem we have is that neither of these candidates are willing to address this issue. Romney has said he's not going to do any major budget cutting in his first year, but he has to. He has to take the budget down by 30 to 40%. There's no one that has, and in fact, what's going to do Obama in? And I had a call from Organizing for America yesterday on this, and I pointed this out to them. Obama came into power saying he was going to put a stop to the financial scams and he was going to put the system right. He's failed to do so, and instead he sat there and did whatever the bankers want. Romney, of course, is going to do the same thing. Just look at his histories with bank capital, private equity. Okay, fine. But the fact of the matter is that we are in a situation now where what the bankers want is unsustainable. It cannot work. And so we need a politician who's going to stand up and do this. And we don't have any in any of the three candidates. We have Obama, we have Romney, and, of course, in the Libertarian camp, we have Gary Johnson. None of them have come out and said all the people who committed fraud are going to prison. We're going to put leverage caps back in. We're going to put Glass-Steagall back in and go to a $1 capital system. The individual who does that has the right formula, but there's nobody, literally nobody, running for president of the United States who's going to do that. So we're going to have a very rough time here over the next couple of years in the U.S.
Karl Denninger, thank you for being with us. Everything Financial Radio will return after these words. Stay with us.